in that scenario. And then you're likely to see something like Bitcoin come back in, which is, back in November, I was the only person out there that was saying Bitcoin isn't going to go any higher than the 65, 69,000. And we've obviously seen it come down dramatically. But I mean, people were just calling me insane. Yeah, so emotion is really, it's what will break you as an investor or a trader. It gets you to do the wrong thing at the wrong time. It gets you to buy something like Bitcoin when it's at 65,000 just before it tops, because everyone's just so excited about it. And so you get that emotional response that is like, oh, I've missed the boat, but I'm going to jump on now. And of course, that's the wrong time to do it. And same thing on the other side where, people that are in investments, when the markets are at their lows and things are just so bleak, it makes you kind of say, all right, I just got to get out because it seems like the world's going to end. And that's actually the time to buy. So for me, it took me a long time, but by letting the charts tell me what to do in terms of looking at specifics on the charts, it really allows you to take emotion out of it, meaning that the charts just tell me what to do. I don't pretend to think or don't have any sort of kind of, feelings on the matter. I shut that off. And then looking at the charts, it really does just tell you the purity of it. And what's amazing about the charts is that charts represent human emotion, really. And so by reading and almost playing counter trend to human emotion, you're able to actually make money. And again, people might say, well, why are charts emotion or human emotion? Well, because buyers and sellers are humans, right? I mean, people are buying stocks or selling or buying crypto, selling crypto. And basically a chart as it goes up, it's telling you people are getting greedier and they're running and chasing it, and vice versa on the downside. So really that's what a chart represents, is that the emotion of the investing public. And it's weird because if you're a contrarian, if you know how to read that and go opposite, that's where you'll find the big money in investing. It just like anything, it takes study, right? So I always like to tell people that you can't expect to come into the market and remember, you're facing like billion-dollar algorithms that Goldman Sachs and these bigger companies built, and they're sharks. I mean, think of great white sharks, and we're kind of like the seals in the water. So you have to learn how to avoid the kind of the pitfalls there of that kind of stuff. So if you're going to be a brain surgeon, right, you have to go to school for X amount of years, you have to study and all this stuff, and you have to pay. I mean, think about the amount of money, right? So the same thing applies to investing. If you want to be a pro, if you want to be someone that's making money, you're going to have to put some energy and effort into studying it. So that's number one. But I think number two is that, the charts, what I've found is that when you have specific rules, and this is the discipline of trading, is that when you have specific rules that you abide by, you start to recognize that, okay, I've done this type of pattern trade 50 times or 100 times, and out of 100 times, it works out 80% of the time. So as long as you have those probabilities on those pattern formations and you actually know what to look for, then you actually start to become the casino house versus the gambler. Like the gambler walks in, generally 1,000 gamblers go in, most of them will lose, one or two may win, but you want to be the house of the casino. So everything I do is based on this pattern forms X amount of times, and it makes this move X percent of times. And I'm just looking for those repetitive features in the market. And the reason why they work generally more times than they don't is because, again, it's all human emotion, right? So that when people are buying that Bitcoin at 65 or 68,000 and there's so much hype, you're near a turning point. Vice versa. Recently we saw crypto just bottoming out and people were panicking as UST was collapsing and all this other stuff. And same thing applied. People were overly panicked. And then now we're seeing the bounce back. So it's just, again, it's noticing and studying patterns. And then when they repeat and the percentages on them and you've done it for as many years as you start to just become robotic and you say, okay, well, listen, 2 times out of 10, I'm going to lose on this trade, but you know what? 8 times I'm going to win. So let me just always do it and then let the percentages kind of handle themselves. Yeah, absolutely. Absolutely. So everything that I'm looking at, like when you see a move off of a low on a chart and it starts to go sideways, what that's telling you is that you had buyers that were probably big money buyers buying at the low, and now you're seeing an equal amount of buyers and sellers fighting, and that's creating a sideways move in a chart, right? There's 50 buyers, there's 50 sellers, so price isn't moving. Well, what that tells you is that the sellers that were just causing that market to drop or that stock to drop, and then the bounce back buyers, now there's not too many sellers anymore. And what that tells you again is that sentiment is starting to change into a more bullish formation or bullish action, and you're likely going to get another move up. That's in technical trading known as a bull flag, for instance. So yes, basically that's what you're looking at. You're looking at buyers and sellers. How are they acting? How many of each are there? And that gives you kind of that edge to kind of guess with higher probabilities on what the next move will be. Yeah. So I don't have a specific algorithm, but I do have components that I look at. So number one, I look at something like a CNBC. I look at the financial media out there. The more articles that are popping in front of me talking about this is such a scary market. It's a bear market, or this is an amazing bull. It's going to go on forever. I start to say, okay, sentiment is too much to one direction. I also look at social media. Social media has become an amazing platform to gauge sentiment. One of the best signals I do is I post on Twitter, right? I'll say, hey guys, I like this stock in this direction or this crypto in this direction. And the more people attack that point of view and say, oh, you're crazy, and they're never attacking it in a technical way. It's always emotional, right? Oh, you're crazy. You're never going to see this go below this price. And all of a sudden, the more people that do that, the more it makes me realize that sentiment has gotten too bullish in that scenario. And then you're likely to see something like Bitcoin come back in, which is, back in November, I was the only person out there that was saying Bitcoin isn't going to go any higher than the 65, 69,000. And we've obviously seen it come down dramatically. But I mean, people were just calling me insane at that point, but it was a great technical kind of, emotional indicator. So social media, the media as a whole are great ways to do it. And you just get this sense by talking to friends, when there's real panic out there, when friends are always coming to you and saying, oh my goodness, did you see this? Oh my goodness, where is the market going to go? That fear is very pervasive, and it shows you that it's permeated a lot of the population. And you start to kind of say, okay, let me now go to the charts knowing that, and look for a double bottom. Let me look for a trend line. Let me see what we're hitting here that's also telling me that there could be support. I would say honestly the charts, because the charts represent the emotion within, just in a form of a chart. So again, I could tune out and listen, we didn't have, social media 15 years ago, really, or 20 years ago, and you could still use charts to kind of predict price action. So I would definitely say charts, but for sure, the more factors you have, and this is something I always talk about, how, it's one thing to have like a double bottom in a stock, but if you could have a double bottom that also coincides with a bottoming tail, with, the social media indicators telling you that things are overdone, the odds of success are going to go up. One factor, like I say, is, maybe 60, 70% success rate. But if you could get three factors, now you're up to 80+% success rate. So it's definitely getting as many things in the right direction as possible. Yeah. So for the most part, like ARCA and NET, INET, they have like night trading and different paths and exchanges. They're all kind of combined into, your level 2. And so it's all traded together, and then it shows up on the chart. So that data should come across on the chart. So really it's all combining that data so that you get it all in one easy kind of way to read. Yeah, I mean, you definitely always have to be aware of that there is kind of this high frequency trading, these algorithm trading, but a lot of the time it just kind of like, I look at a big enough time frame where the smallest time frame I'm day trading off of would be like the 10-minute chart, which is, so each candle is going to be 10 minutes. And generally I even go as big as like the 60-minute, the hourly, or the daily. And again, the bigger the time frame, the more fluid and kind of reactionary the chart is going to be, where it's going to kind of smooth out those little, the quick little trades by these algorithms that are just trading for a penny here, back and forth with each other, versus what we're looking for, which is more of a macro move. So like on a swing trade, for instance, holding a swing trade, something where I'm buying something and I'm going to hold it for days or maybe even a couple weeks. So the general move will still play out in that time frame.